Good day and welcome to Small Caps on this January the 20th. I am David Scott. Thanks for your company today. Let's get straight to the boards and have a quick look and see how the market is faring. About halfway through this Friday session, we're up marginally on the CBOE Australia 200 and also the XJO. The small cap universe not faring quite so well today. The small ordinaries currently off around 0.2%. Well, with nothing more to do, let's go and straight to our guest for today's program. Luke Winchester from Merewether Capital is standing by via Skype. Luke, good to go and see you there, and thanks for joining us here on the Small Caps. I want to go and ask you about City Chic Collective. Now, it was a high-flying stock in the early days of the pandemic, but it got demand trends all wrong. Now it's going to battle against margins getting squeezed. It's having to go and discount, but it's now starting to go and clear its inventory, and it's got a billionaire on the share register. Really interesting to go and make what you think of the outlook looks like from here.
Yeah, there's a lot going on, Scotty. As you said, this was a real fundy favourite, and with good reason. The business performed really well, even into the pandemic, but then juiced by that big consumer pull forward, that big spend we had. And arguably management just got a little bit too ahead of themselves. A very large inventory build, which then started to cause some real headaches as that consumer demand shifted, sales started to weaken. All of a sudden, you've got a discount to try and get that product out the door, and the margins take a big hit. So this started to happen, as you can see, that sort of 5-year chart started to happen at that back end of 2021 as a couple of weaker updates started to come in, and then the snowball starts to roll as those operating metrics really start to deteriorate to where we are today. But a few interesting things have happened over the last few days. So Brett Blundy, the retail god, I guess is a way to put it. The guy who just has a golden touch, no matter what he gets involved in across, Lavissa and early days with bras and things. He's now popped up on the register. Only 7% of the stock, but a sizable chunk, and enough where certainly the market gets excited because there's some influence that could easily be wielded with that sort of size of the business. So, look, you sort of match that with, okay, maybe operationally or strategically, I guess I would put it a better way. If you've got someone like him at a board level, maybe guiding what could be happening. You have the trading update come through today, and so what's happening with the here and now? Where does the business sit? It was pretty mixed, to be honest. I thought the update, the trading update for what we saw in the first half of the year, so that crucial lead up to that Christmas period, it was pretty weak. Sales down 8%. No specific margin guidance, but note that the gross margin got hit. Pivoted to an EBITDA loss, so obviously negative at that EBITDA level, and then it'll be worse at the net profit line when you deduct all the non-cash items. The question becomes, well, what do we look like now for that sort of recovery in the second half of the year, and I guess into that crucial trading period into calendar 2023? What does the consumer look like at that point in time? The big focus from the market's always been on their inventory level. They've sort of said they've got that down to a level less than what they hoped for, which is a good sign. It also means their cash isn't too bad because you're winding down your inventory. You're not having to spend cash to rebuild that. So they're looking to pivot from net debt to net cash as that happens. But of course, you then have to hit your normal working capital cycle and rebuild that over time. So a lot of moving factors going on. You've got Brett Blundy, you've got the business, going through arguably a turnaround right now. How does it all shape up? I think the key question you take a step back, though, and ask as an investor, either in there today or on the sidelines looking at it, is, has there been any damage to that brand? Look, I'm not a shopper at City Chic, obviously. I would struggle to think that there's been huge brand damage to what they do. They're not really a luxury retailer, so discounting of their product lines probably doesn't impact them from that point of view and change the way consumers look at the stock or feel about it. So it's a fair one to look at for that turnaround, and you've got a guy there in Brett Blundy. If he does take more control, that's the assumption the market's making. It's not actually guaranteed, but if he does, that I think there's a core business that you could easily turn back around to. So look, I don't own it from Merewether Capital. I think there's too many moving parts to really jump in and get excited today, but I love following all these sort of goings on, Scuddy, as I'm sure you do as well. It's just interesting to sort of track these stocks and as bellwethers, I guess, as well for what may be happening across the wider market.
Well, that Blundy bounce yesterday up about 40% or so. That's quite a move, but of course, it's put in the context, it's been absolutely shellacked. Really interesting as well. And in the company's defense, I know that it got the inventory levels incredibly wrong, but we're coming out of such an unusual period. I'm not sure so much blame can be apportioned there, just to know it was such unique circumstances at the time. Anyway, let's go and move on to the next company we want to go and focus on now. This came through late yesterday, CTI Logistics. It's upgraded its guidance. So what's behind that? And do you think it can go and continue those tailwinds it's seen?
Well, let's tie these two things together, because City Chic, the reason for that inventory build at the time was management looked at supply chains and logistic chains around the world and said, we sort of want to get our hands on whatever product we can right now because we don't know what that will look like in the coming months. CTI Logistics, one business's issues or problem can often be another business's tailwind. And that's where these guys sit right now. They're a logistics provider primarily based over in WA. And as most other businesses have found supply chains and logistics chains quite difficult to manage, these guys have reaped the benefits of that. They've seen a shift from their customers towards more premium products, more premium services. They're trying to get products delivered on time and to the right places where they need to be. And you've seen a massive increase in margins. So to answer your question as to where do things go from here, that's the key question to investors. So the announcement comes through late last night. They're now expecting first half profits to be upwards of 90% growth on last year from where they were at 60% growth. That's a big increase. And I start to run some numbers and you get towards, maybe 10 to 11 mil net profit for that first half. It's not a business that has a great deal of cyclicality. So if they can maintain that momentum, you're talking about maybe 20 odd mil earnings for a full year. And on a market cap of, I think, about 130, you're looking at a business that's very cheap, somewhere like 5 or 6 times earnings. But the question quite clearly, as you said, Scuddy, is that's a business that is likely over-earning right now. They've got the exact opposite of City Chic. They've got all the tailwinds behind them. How long do they continue into the future? What does it look like when that normalizes? So the market won't extrapolate this sort of growth and these sort of results, into the future. But they snuck that update out late last night. I thought it was very interesting. I've chucked it on my watch list to really dig into this stock. I think it's a very well-run business. It's a bit of liquid. That's something to keep in mind for people. But you're not talking about a business where I think those tailwinds pull back to exactly where they pre-COVID. I think there's a business that's sort of grown a little bit through then. You get some moderation in that, but I think to a much higher level than where they've been, and those earnings, maybe around that sort of 10 to 12, and it pulls back to maybe 9, 10 times earnings. Still very attractive level for what's still a compounding business. So again, I don't own. One, I'm much more interested in the City Chic though, just given the momentum and where it's going, and obviously that valuation.
Yeah, CTI Logistics, as you mentioned as well, based in WA, and there's a commodity boom underway, as many people have probably noted as well. That's undoubtedly probably going to helping now with earnings at the moment and demand. There are lots of jobs going on in the mining sector around WA. To go finish off, mate, I want to go and talk about medtech. Now, not in the small cap universe, but Fisher and Paykel out with an update today. Really strong. It's one of the top performers on the 200. Also, Nanosonics earlier this week did a guidance upgrade as well. And really begs the question, is this more of a trend than isolated, this strength?
Yes, well, that's the question I'm sort of asking myself. And I think as investors, it's a good habit to get into and sort of say, well, what am I seeing across the market with businesses as they're reporting and providing updates and news? And I think a common theme, the last couple of days, Nanosonics, Fisher Paykel, they're not businesses that compete with each other, but they're definitely in that same space. They're selling to the same customers as, hospitals and clinics. They've been heavily disrupted over the last couple of years as those customers focused on the pandemic, all the challenges that came alongside that. And when I see two businesses come out in consecutive days and give their trading updates for what they've seen the first half and their outlooks for moving forward, and they both are more positive than what the market expected. The commentary is positive around being able to sell easier, those challenges we just spoke about with CTI Logistics, supply chains, logistics starting to ease. I get interested and I start to think, okay, well, if that's indicative of what could be a wider trend across that space where these sorts of businesses are able to get out there, get boots on the ground, get into hospitals, get into their customers, sell easier, then who else could possibly benefit? I'm a small cap investor. Look, I'll talk my book here a bit, Scuddy. A couple of stocks I have in the Merewether Capital portfolio, Osco Healthcare and Compumedics, two businesses that both sell into hospitals. Osco Healthcare are nurse call systems. Compumedics does some brain and epileptic medical devices. So that's sort of how I think about situations like this. It's, when I look at the large cap peers, obviously I'm not necessarily looking to buy them, but what insights do they give me? They're larger businesses. They see more of their customers, competitors, supply chains. Are they seeing the issues start to subside? And if they are, it likely does bode well for guys like these. So I certainly sat up and paid attention when I saw Nanosonics yesterday. Fisher Paykel comes out this morning and sort of, you now got 2 data points. And I look across and I think to myself, will someone like an Osco Healthcare or a Compumedics also start to see the unwind of the challenges that they've also seen over the last few years? So a couple of interesting ideas there. And just for disclosure, they're the 2 I do own.
Yep, allowed to go and talk your book. And yeah, once is an anomaly, twice a trend, I think is the saying that goes. So we'll keep a close eye on those 2 names that you've gone and mentioned there. Thanks for joining us on the program as always. We'll catch you soon.
Awesome. Thanks, Scotty.
Luke Winchester there from Merewether Capital. Well, moving on to our C-suite interview today, and tin, it's the forgotten EV material. Well, not for much longer. We're going to go and bring it to the attention to you. So Nadine sat down with Joe David, who's the MD of Elementos, earlier today, and started off by asking him why there's not a more conversation about tin, given its importance in the battery material space.
Fortunately, people don't yet see it as the key ingredient in solder, and solder feeds into every electrical circuit. And obviously, as we move to electrification and green infrastructure of tomorrow, including EVs, of which you mentioned, tin's use is just forecast to go, up very substantially.
Okay, so why? I mean, we started out by saying that global tin stockpiles are at record lows. Like, why?
Well, demand's going up, clearly, for the reasons we just covered off, basically the electrical future and the use of tin as a solder. But then the other critical element is supply. There has been no significant supply side added to the tin market in 20 years. China's a major supplier and they have not been able to increase their tin output for 20 years. You then go through the other major suppliers being Indonesia, Bolivia, Peru, Brazil, and the DRC. There's not much security of supply from any of those countries for the global manufacturing markets. But then you get down to it, there's just been so little supply added into the market, as I said, over 20 years.
Okay, so is this the case of everybody's sort of onto this and everybody's going and digging for tin and trying to get these mines up and running? Or is it still a case that it's very much bringing old mines back to life? Like, is this going to be a oversupply meets demand story? Just give us some of the dynamics of what's happening out there.
So I guess the reason why there's been so little the underinvestment over the last 20 years is the market's always just been able to match the supply and demand. A couple of things have materially changed. We used to have a huge strategic supply in the US. US used to have 70,000 tonnes at the turn of the millennia. That is gone. They've sold that down to about 3,000 tonnes. So that's been sold into the markets. That was one of the, flex points which helped balance the market. The second was the artisanal supplies coming out of Africa. Before we really moved to responsible supply, there was a lot of child labour and other poor practices coming out of Africa and a lot of those countries that were supplying some of the tin, that flexible tin coming into the market. That, with all the regulations, that's really dropped off, and the market's not seeing that supply come in. So they're the 2 reasons there's been a material underinvestment. Now, coming back to, this isn't copper. There's not 200 juniors, trying to get copper mines up and running at various stages of development. There is a handful. There's only 2 listed tin producers on any of the exchanges globally, and only 1 in Australia. And there's probably about 8 of us juniors trying to develop mines. Some of them are greenfield, new mines, and some of them are restarting of old mines. Us, as Elementos, we have a greenfield project in Spain, and we have a brownfield, the restarting of an old underground tin mine in Tasmania. So a little bit of both.
Why Spain?
Well, Spain's a fantastic place to have a mine. In terms of Europe, people are a little bit afraid of mines, but Spain is very pro-mining, especially the south of Spain in Andalusia, where we are. And the other major reason, Europe has no tin mines, has no tin supply. So as we move into a world of, critical and the geopolitics situation, and each, corner of the earth trying to get its own supply, and Europe's very, very keen at developing its own supplies of these critical minerals. There is no tin supplies. So we and our Oropesa project in Andalusia in Spain, we want to be Europe's new tin supply. And when we get our project up and running in about 2025, we will have we'll be producing about between 1 to 2% of global tin supply.
Do you have any offtake agreements? Like, I'm wondering who would be buying the tin. Does it go through a sort of supply chain before it gets to the end? Solar manufacturers or car manufacturers, whoever is going to actually put it in product at the end?
Yeah, absolutely. So the main, you generally have tin smelters in the middle. So most of the tin smelting in the globe is centered around Southeast Asia. So Malaysia, Taiwan, Thailand, and China. They do most of the tin smelting, which again has introduced some quite significant geopolitical risks with all that smelting being done in such a small corner of the globe. Europe, and certainly with some of the off-takers we're talking to, very keen on developing its own smelting capacity. That takes it down to a tin ingot. So effectively like a gold ingot, tin ingot, and then that gets secondary processed by solder manufacturers into wires and those sorts of things. So again, we're working very closely. We're talking to the traders, we're talking to the smelters, and we'll assess that. We're currently working through that process. But our ultimate goal is to have all that done within the EU.
Okay, so interesting. When I think smelting, I think dirty, bad air, again, sort of going against what we're being told is sort of the raison d'etre in the European Union in terms of clean and green. It's also sort of like hard to get your head around all this clean and green technology coming from such dirty processes. What does tin smelting look like in a Western country in 2025 and beyond?
Yeah, I think, again, the reason why traditionally all that smelting was centered in that Southeast Asia is because they had those lower thresholds, exactly what you said. They weren't as focused on reducing the environmental releases into the atmosphere. Now, that world has changed. Back in Southeast Asia, they're not so keen on that, and the technology on the back end of these smelters has greatly improved to really filter out a lot of those bad toxic chemicals going into the atmosphere. And certainly the technologies that we're talking to potential partners with in Europe are doing exactly that. So you can scrub a lot of the bad stuff out of what goes into the atmosphere, which is fantastic. And certainly technology's come a long way from that traditional view of what smelting looks like.
Okay, interesting. So just let's touch upon the tin project in Tasmania. So this is bringing an old mine back to life. Is that significantly cheaper? Can that happen quicker? Can you start selling the product before 2025?
Yeah, hey, the short answer is no. And I guess just to put some context on it, our focus is the project in Spain. So
okay.
we're certainly pushing that one ahead. Most of the timeframes, as most miners will tell you, is on the regulatory side. So basically from the moment you finish your technical studies, you basically go deep into your regulatory applications to get your mining license, your environmental approval. So unfortunately, whether you're doing a greenfield project or a brownfield project, those timeframes don't change greatly on average, talking generally, of course. So certainly we're much further down the path on our Spanish project than we are in Tasmania. Our Tasmanian project, while it is the restart of an old mine, I'd put that more as an exploration project for us, being the Cleveland project in Tassie. So as I said, major focus of us is getting the Oropesa project in Spain into operation by 2025.
Joe David from Elementos joined us earlier on today. Well, that's it for the program for today and for the week. Cracking Crypto is coming up after this very short break.